people that have an interest in the economy, not just trading 4-hour charts and scalping, to get the big picture today. We're fortunate to have Dr. Kamal Shri Kumar. And Shri is a global macro economist. So, we're going to start in the States, but there are other things around the world that we have to talk about as far as growth engines. And you have some good clients because what Shri does, he doesn't advise a retail trader like me and you, all you guys watching, although he has a letter that I urge people to use in their intelligence gathering, but his clients are multinationals and sovereign wealth funds. So they don't just retain anybody. Welcome to TradeGATEHub, Shri. It's great to see you again.
Dale, great to be with you and great to have this discussion this morning.
Yeah, there's so much going on, but I was talking about when we were kids, we had to clip out a newspaper article and talk about current events when we went to class. So the current event today was the CPI, and the core was a bit sticky. Your impressions of this number?
If you look at what happened immediately after 8:30 a.m. Eastern Time, Dale, there was quite an amount of rejoicing that the inflation number had not picked up. There were no negative shocks. Then I think the markets took a closer look, and below the headline number, and there are some troubling signs, and which is why soon after you saw the various indexes dropping sharply in the minutes since. What happened? You find that the core inflation rate month to month accelerated from 0.2 to 0.3%. That is one thing.
Yes.
Then you go below those numbers and say, why did that happen? For the interest of your viewers, the core inflation rate excludes food and fuel, which are considered volatile elements. So you have the headline number, which includes everything, which gave you a pretty benign picture. But the core figure, which excludes the two items, that picked up month on month. Why did that happen? Gasoline prices fell 10% year on year last month compared with a year ago. Obviously, that brought the headline number much closer to what the Fed would want. However, what is the troubling element here, the fly in the ointment, is the fact that rent cost, which has been a sticky item in inflation, accelerated from 5% year on year in the month of July to 5.2% year on year in August. And in August compared with July, just 1 month, the acceleration was significant from 0.3% to 0.5% month on month. Why is this troubling? Two reasons. Rent has about a 36% weight in the consumer price index basket. It's a huge element. Even the fall in the gasoline prices in future cannot make up if rent costs continue to rise. Second, we all know that home prices have continued to increase to record levels month after month. What that means is lower and middle income people are no longer able to afford their first homes, especially with the mortgage rate being so high. So what do? They go into the rental market, not because they want to go, but because they can't afford to buy a house. So that is going to continue to put upward pressure on rents, and it is going to be an element of social pressure for the next administration, whichever one it may be. Rent cost is going to be a big problem they have to resolve. And therefore, this bad news is the consumer price index is not going to go away for the Fed as a problem. It is going to persist because they can do very little to control rents. That depends on how much housing is available, how many houses are built, and therefore the Fed will have to continue to deal with it.
Okay, you know what? It's not theoretical because your host today just received a 10% increase on his rent, and it's not because home. I wouldn't buy a home now. I sold my property a while ago, early. I didn't catch the big move from the pandemic, but I think that that's a bubble too.
Yeah.
So, okay, so I think this is the everything bubble economy, in my view. That eventually something you're worried about later on, a credit event that we see in a small fashion when we get sell-offs in stocks, they sell everything,
Right. Exactly
right?
right.
Okay, so with that being said, your headline for this interview is that the Fed folds on inflation. This is a policy error that the Fed is making. And, there are other people, Shri, that believe that the Fed has already made a policy error and they're behind the curve. So, what do you say to those people that are clamoring for not a 25 basis point cut, but 50 next week that they won't get?
It depends on what your objectives are. So if you are looking just to boost stock markets,
Okay.
or if you have a position in a number of risk assets, and that's what you're doing, you should be looking for more inflation. Why look for 25 basis points? You should be looking for a full percentage point cut in interest rates. Then the Dow Jones Industrial Average will momentarily rise by 1,000 or 1,500 points in a day. The S&P 500 index can rise by 2 or 3% in a matter of a day or two, and then you can clean out. If that is your objective, sure, ask for more and more interest rate cuts. However, we have to keep in mind that that is not supposed to be the Fed's mandate, even though they behave as if cheerleaders for the stock market is what they were born to do. The real mandate is inflation control and maintaining steady growth in employment. That's what they are there for, not to make you and me rich by being in the stock market.
Also, but isn't that a major source of tax revenue that in these times of huge deficits, we financialize the market to help subsidize the government?
That's exactly right. And we have a Federal Reserve and a chairman who has said repeatedly that he will not comment on fiscal policy, that the fiscal deficits are not going to intervene in his decision to cut or raise interest rates. And that is just sheer economic ignorance, lack of knowledge of theory and how monetary economics works. Because if you were head of the monetary policy, you have to see how much stimulus is coming from the fiscal side. If there is a lot of fiscal stimulus, you have to cut down on your monetary stimulus. What we found in 2020 is with COVID coming on, and then you had about $900 billion of spending in the final months of the Trump administration. You had another $1.9 trillion worth of spending in the first months of the Biden administration, and inflation picked up. Not
Yes.
surprising at all. It was the only person who was surprised was Jerome Powell. What did he do? He said, well, I don't have to worry about fiscal policy. I worry only about monetary policy. So I'm essentially going to shut my eyes to what's happening on the fiscal side. I'm going to cut interest rates down to zero, and I'm going to double the Fed balance sheet from the beginning of 2020 to the beginning of 2022, even though the Federal Reserve balance sheet was already bloated from the post-Lehman Brothers expansion. So we never had a chance to come back from Lehman Brothers back to normalcy. Before we could do that, the chairman had adjusted to COVID by doubling the balance sheet again. I think for your viewers, it is helpful to have in mind that when COVID is there, the way to conquer COVID is not to double the money supply. It is to find a vaccine.
Yeah.
And this reminds me of the Ben Bernanke policies of quantitative easing, and he thought zero interest rates would boost stock markets, make everybody wealthy, and push up the pace of economic growth. Instead, what it did was to impoverish the low-income people who could not invest in the stock market. The
Yes.
bank interest income went down to zero. Retired people who could not take a risk in the stock market, their incomes went down to zero, and the income inequality worsened during the Bernanke and Janet Yellen chairmanship. And what we didn't learn a lesson. We just continue to do the same thing.
Well, there are stats. I saw a tweet by Charlie Bello who shows that U.S. households have never owned more stocks, have never been more heavily committed to the stock market. I think it's 62%, which is a big number. So, what's your best guess of the percentage of people that have benefited from the bull market in both stocks and real estate out of our population?
Out of our population, if you say how many of them benefited, and I'm going to extend your question, Dale, and say how many benefited and how many in some ways lost out.
Okay.
The people who won, I'm going to say clearly the top 1%, the top 10% clearly were beneficiaries. They had a
Okay.
lot of excess savings. They put them into risk assets, which have gone up substantially in value. Homeowners, they did well. And what percentage of that? Let us say, roughly speaking, about a third of the people may have benefited one way or the other from the higher stock prices. And what they gained in risk asset price evaluation increase, they more than made up in terms of whatever they had to pay for the higher price of eggs and milk. That
Yes.
didn't bother them. The
Right.
bottom two-thirds, I think, lost out because for them, the wages did not increase as fast as prices did. And they
Yes.
were not homeowners anyway. They were hoping to become owners, but they couldn't do it. So, net net, I think we lost out with the stock market appreciation coming from this monetary expansion and zero interest rates. The basic tenet of economic theory is the following: economic growth to be sustained has to come from productivity growth, labor force increase. That means instead of having 100 people do work, we have 110 people working now. You're going to produce more goods and services. Second, you used to produce 5 widgets per hour. I make you more efficient, and now you produce 7 widgets an hour. That also produces more economic growth. That's the way it's supposed to come. If I flood the market with cash, and if you double the money supply as Argentina or Haiti were used to do, you should have Argentina and Haiti being the most prosperous countries in the world. The reason that is
Exactly.
not the case is it's not money supply that makes you rich.
Okay. So, a source of what could be exponential productivity gains. Could it be AI? Are you hopeful that AI can replace the printers and the spenders to get real growth in the economy? But at the same time, isn't that going to cause huge displacement and employment issues as people get replaced by AI? How do we come out ahead in that deal?
Let me deal with your question in three parts. How do you rate AI and the prospects for it on the one side? And can that beat what is being done on the monetary side? Looking at it from the AI point of view, I think it is a great revolution. And I still remember the times before email when we all had to call each other and leave even voicemail in each other's phones. I called you, you are not there, then you call me back, you missed me, etc.
Yeah,
And rather than that, just to be able to email you and you get the time to answer me when you can has increased productivity and it completely changed the system. I think AI is going to be a multiple improvement in terms of what we went through in the mid to late 1990s and the early part of this current century. I have no doubt about that. You talked about displacement. Displacement is definitely going to come, and computerization often involves the people who do basic work who are no longer needed to do that kind of work. And I think the displacement is going to take place. So that is the fact of life. Long term, you have improvements take place, and the investors, the people who are going to benefit, are those who seek out what skills are going to be in demand and how they can adjust to the changing economy. Not everybody would be able to do it. Some would not be able to guess what is going on, or some others may not have the skill to adjust to it. And in that case, they are going to lose out. My point here is that during that situation, what you need is more training, more education. And if you, in terms of what I mean by that, look back to Germany in 2003. In 2003, the country was known as the sick man of Europe because they essentially had a situation when the economy was not headed anywhere. What we had then, Dale, was an entry of Gerhard Schröder as Chancellor of Germany, and he introduced something called the Hartz reforms. And what that said essentially is that if you lower your salary somewhat to get training in an area of much demand, then the government will also add a subsidy to the whole process to your employer. And what we found as a result of that is that we had the situation improve dramatically and the pace of economic growth improved. So coming back here with AI, what you need is for the government to be able to spend money on education and training rather than just provide subsidies in various different ways, which essentially get wasted. That would be my way of taking care of the problems of unemployment arising from AI's dominance. Last part, you asked, how can the Fed deal with this? I'm sure the Federal Reserve people will find more ways of causing inflation, despite the fact that AI brings several prices down with efficiency. They can always increase the pace of money supply growth, the rate of the interest rate that is being charged in order to keep inflation a live issue, even with AI's dominance.
Okay, that's interesting. Alexis, if you could let me share my screen, please. I'd like to talk about, you brought up Europe. And since you are a global guy, here's my concern. In 2008, during the Great Recession caused by housing, we were the epicenter. There was still a pretty good engine of growth coming out of China. And in my novice opinion as an economist, they were able to help, besides what we did monetarily, bring the world out of the Great Recession. They were still an engine of growth. Now they're an engine that has thrown a rod and is they're still weak and they haven't really used their bazookas. If they could pull us out of recession, could that be the epicenter, or could it even be Europe this time because they're already in recession and the dollar has been losing ground to the euro, which should not make it easier for Europe to come out of their economic doldrums?
Europe, there are two things about Europe. One, yes, you are correct in saying that the European recovery has been very sluggish, much slower than has been the case with the American recovery. So clearly they are worse off. On the other hand, two things are in Europe's favor. Unlike in the United States, the European inflation, or at least the Eurozone inflation, for those countries bound by the European Central Bank, the inflation came mostly from energy prices. It came from the fact that Germany and Italy were two major importers of natural gas from Russia, and natural gas prices had shot up with the start of the Ukraine conflict. What has happened since is that natural gas prices have plummeted over the past year. And therefore, with it, inflation in the Eurozone has also come down. The
Okay.
United States, we don't have, go ahead.
All right. Well, I just want to say that Wayne Gretzky talks about, I don't go where the puck is, I go to where I think it's going to go. And the honeymoon that Europe had with cheap natural gas prices, and you were absolutely spot on about the decline. A picture speaks 1,000 words. This is what Sheree is talking about. These are historic lows that we're getting right here, but we're on the verge of turning in natural gas. I actually think natural gas is a sleeper, even though it's called the widow maker. Might leave widows with a nice stack of cash on the long side. If we get through 220, we could make a pretty good run here. So if that goes wrong this winter, because, you know, last winter or the winter before, Europe was going to freeze and starve to death, but they had a warm winter. What if the weather doesn't cooperate in Europe this time? They're not subsidizing as much of the bills, the heating bills in the UK for their citizens. Could this, which has been kind of a panacea for Europe, turn out to be a problem again?
Great questions. Let me answer you in a few sections, Dale, if I may. One, you are right. Weather is unpredictable. We did not expect a warm winter last time. Europe lucked out.
Luck.
And that price, various energy costs down quite sharply during the winter and spring that we had before. Let's assume for a second that the next winter they are not so lucky, that it turns out to be a pretty harsh one. There are two benefits now. One, Germany and Italy, which are the two big importers of energy from Russia, have diversified their sources. They have looked at countries like Algeria, they have looked at Northern Africa to get more sources of natural gas, which used to come from Russia. The United States, through shipping, is also a big provider of liquefied natural gas, which are going to Europe, and that has also improved the situation. So one way it's going to be better is the fact that Europe is no longer dependent just on Russian energy.
Yes.
They are dependent on other countries, and that is going to mitigate it, not remove it. You are absolutely correct. If it's a harsh winter, natural gas prices will rise, but they may not rise as much as they did 15 months ago, say.
Okay.
Second part, the European countries are more likely to do well coming together. 3 years ago, if you had asked me, will they issue a common bond, I would have told you it makes little sense to do that. However, the person who sponsored my PhD dissertation, Robert Mundell, who got the Nobel Prize in 1999, he had the crazy idea in the 1960s that those European countries could one day have a common currency. And they
That's
thought,
been the missing element, Sheree, right? I mean, everyone's saying this experiment was going to fail because they didn't have, a federation. That it was just they were bound by the currency, but each country is still an individual country, so they can't coordinate fiscally.
right, that is what they said. But look at what happened. We had about 3 years ago the first European common bond issued for 750 billion euros. And it was essentially a reaction to COVID. And how was it done? It was issued in the name of the European Union, not any single country. And who got most of the benefit of it? Italy, which is often thought of as a spendthrift. It is thought of as a country that spends too much.
It's a basket case.
Right. And
People call it a basket case.
They got more than 200 billion euros out of the total of 750 for the entire region. Now, it is not a gift to Italy. In order to get it, they have to comply with the European Union regulations. They have to play a game. You cannot be like Silvio Berlusconi, the prime minister, used to be in saying we are going off by ourselves and we are going to align ourselves with Russia and then have a common force against the rest of Europe and the United States. Italy just did not do that. They came
Okay.
together, and that is also a big difference in terms of where we are going in terms of inflation, with even if natural gas prices rise. Last point, this is very timely. We have this discussion. Just 2 days ago, Mario Draghi, the former
Yes.
head of the European Central Bank, who the European Union had asked to look at a study to tell them what to do, he came forth and said, if we, meaning Europeans, should be competitive with the United States and China, what we have to do is to issue more common bonds. Now, what is the first common bond they issued comparable to? It is a huge milestone when they issued the 750 billion euros in the common name. I have compared it with Alexander Hamilton, the first US Secretary of Treasury, issuing the common bond in 1789. When they did that, of the 13 states in the United States, we had profligate Massachusetts and very conservative Virginia come together in issuing a bond. Why should Virginia go with the big spending Massachusetts in issuing it? Hamilton's point was, if you do, all of us will be able to borrow at a much lower interest rates. And that is essentially what happened. And despite the German opposition in the last 2 days to more common bonds, I think that's where Europe is going toward. That also means European risk will be lower and the impact on European inflation will be mitigated.
Before we get to the banks, because I want to cover that because of what's going on here the last couple of days, and your major concern, Shri, is last time we talked, the dollar was, trading in here, and I talked about a lower dollar and higher euro. Do you think this move in the euro with what you're talking about with this bond is going to be supportive for higher euro prices because it takes the risk profile of it down?
My expectation is that between the dollar and the euro, we are trading at 1.05 to 110, meaning a
Okay,
dollar
the
and 5
range.
cents to $1.10, you're going to be in that range.
Okay,
What determines whether you're at 105? It depends on if the Fed looks like it's going to cut only by 25 basis points, then the dollar strengthens a bit. If you have more expectations for rate cuts here, the dollar goes toward $1.10, $1.11 for the euro.
okay.
But the bigger story to me is, don't look at the dollar euro alone, don't look at the DXY dollar index alone, look at the price of gold. Again, Bob Mundell used to say, and we have always thought of the gold as the ultimate currency.
Yeah.
Think about gold versus the US dollar and think about gold as a currency. What has happened is from about $2,000 an ounce at the beginning of the year, we are trading at over $2,500 just about 8, 9 months later. That tells me that the world investors are thinking about the alternative to what is happening,
Fiat.
fiat currency.
Okay. And Bitcoin's part of it, a little bit of a risk parameter, but while we're talking, the S&P has basically given up all of the gains that it tried to recover and still looks pretty vulnerable. And everyone was waiting for the Russell to double this year. I mean, there were a lot of analysts, well known, that were talking about the Russell doubling. To me, that's a pretty negative chart. I just want to now go to what happened yesterday with the credit warnings about credit quality. And why don't we just use the XLF as a proxy? It's lower beta than things like Goldman, which really took a hit in a matter of a couple days. And you also have JP Morgan was down sharply. It looks like we may have peaked here. And the XLF, which is a lower beta, um, also has put in what I call a breakout failure. That's where you break out over a triple top and then you're back underneath it, and the people that thought we were in for a new leg are now trapped. So I want to talk about the banks, and you brought up Michael Barr, who I believe the banks were lobbying to not have to come up with the type of capital requirements that were previously going to be required. And the outcome of that, in your view, is it makes banks less safe.
Exactly. It makes them less safe because the increased capital requirement was essentially to reduce the risk of the Fed having to enter the market and bail institutions out, as it has done from time to time. This is the problem that I have. Apart from the fact that the largest banks get a free pass, namely that they are in a situation where they, no matter how badly managed a big bank may be, they won't be allowed to fail because the Fed will always bail them out. That is what you call moral hazard, or the risk that a large institution can get away with all of that. The risk on the other side is that when they have to bail out these institutions, the Fed is going to create extra cash, create new money supply, and increase inflationary pressures. And that in turn will put a burden on the lower income people who suffer from inflation. And
Yes.
the higher income people able to buy those stocks are going to get away with the benefit. And that's exactly what happened in the post 2008 setup.
Okay. Do we ever get to a point where the Fed is pushing on a string? Remember that expression that no one even remembers except guys like you that and me that have been around for a long time? What's that mean, pushing on a string? Is that what you do when you fly a kite?
Pushing on a string is often used at the time pulling on the string. Let's look at the opposite.
Okay.
That means when you're flying high and inflation is high, I pull at the string, meaning I bring you down from your high levels, I bring inflation down, I starve you of your ability to spend, therefore you spend less and you bring the prices down. That is the idea about pulling on the string. Pushing on the string refers to the fact that spending is very weak and the Fed steps in and then lowers interest rates, increases the money supply, looks at you and say, are you spending more money now? Are you causing economic growth? And that doesn't often follow. Look at the post 2008 setup. There
Yeah.
was a lot of pushing on the string. On the other hand, the economic growth never picked up to a very high level. So
Okay.
the basic point is you cannot push on the string. As we said before, we need more workers. We need for you to make more widgets per hour than you used to do before. That's how you get faster economic growth.
Okay. How do you imagine this credit crisis centering in banks developing? Does it reoccur in the regionals, or is it a money center situation? What are you looking for that'll tell you what your narrative is manifesting?
I do not look at individual bank stocks. That is not part of my expertise, but let me look at it from a 30,000 foot or a 10,000 foot outlook, Dale, and give you my view. I think small and medium sized banks are still the focus of the crisis. They are the institutions which have lent most money to smaller to the commercial real estate,
Yeah.
which is very much in trouble. So that's the point I would make. The larger banks, if they are in trouble, you and I may never find out about it because they'll probably get bailed out because the bigger banks have a close relationship with the Federal Reserve, and the Fed in turn will make sure that things are done so that the big banks are not weakened so much that they cause a systemic problem. So the issue is a big bank will never fail. However, in order for it never to fail, the Fed is going to cause a lot of disturbance, dislocation in the market, like flooding the market with liquidity, cutting interest rates very sharply, and creating other problems for the macro economy, even though that individual institution may get saved in the process. Does that make sense?
Yes, and can't this happen in Europe first?
It can happen in Europe as well, and again in Europe also, the same moral hazard issue exists, namely that a large institution will not be allowed to go broke, whereas
They
a
won't
small,
let they won't let Deutsche Bank go down.
they will not let any large institution to go down. They will get saved. That is correct.
Okay. All right. Well, what is the uh, best idea for people that are confused about this market volatility that we're having, the Fed making a pivot that you disagree with? You're saying inflation is a risk, and you brought up gold. Um, I know you don't give advice, but should we all have some physical metal as a hedge against everything you're talking about that the Fed is about to do?
Clearly, gold is going to be a hedge for you. That is one. And again, areas of real estate, commodities in general are going to be a hedge for you. Anything that is a real asset is going to be to provide some element of protection for you from overall inflation. So I think uh, those need to be part of any one investor's portfolio. So in other words, don't just be in a 60-40 equity fixed income portfolio. Times are changing, and you need a percentage of your portfolio to be in other areas, gold, commodities inclusive. Gold, I think, in my mind, has further upside potential because of what I see happening to global central banks. Everybody is thrilled that global central banks are all joining together to cut interest rates. If that happens, and if there is an undisciplined cut in rates, where do you go? You are going to go into gold and real estate to seek protection from higher inflation rates.
Okay, and just a couple of things for people and for you. I'd like your comment on this too, Shri. Inflation coming down, agricultural commodities since the invasion, when people were worried about wheat supplies out of Ukraine, this has benefited, just like that natural gas chart I showed. So, can you imagine if these bear markets that have been contributing to lower numbers, even though we remain sticky at the core, if we had bull markets in grains and people are already complaining and unable to buy groceries, what it could be like? And I know that you're uh, a bit neutral on the dollar and you're calling it a trading range, but I just want to show this chart right here and how important this trading range is for it to hold. Because if we start taking out par, which is what I'm looking for, we break the range and we could be embarking on a dollar decline.
We
Okay.
are, let me be very clear on the dollar decline. When I talk about the dollar being in a range, it is only with respect to other paper currencies.
Okay.
Dollar is not range bound, and I have just said, and I will reiterate, the dollar is on a downward gliding path. It's a one-way, one-directional move with respect to gold.
Okay. Well, and it would even it shows you how what kind of problems we might have with the dollar because I know they're all fiat, But if your fiat is losing ground to other fiat, that's a problem. And we could be talking about, maybe a 10% move on the downside. Um, they're already trying to talk the dollar down, former President Trump, J.D. Vance, because they want to uh, generate more sales, export sales, maybe help the farmers out, have China come back into the market. How is it possible for an administration to want and get a lower dollar? What can the administer say, for example, they won the election? Uh, how do they drive down the dollar?
One way to drive the dollar down clearly is talking it down, because this is a
Okay, jawboning.
time-honored principle in US monetary history that the secretaries of Treasury or the Federal Reserve, a chairman, makes statement which cause everybody to sell dollars. So you can do that. So if, as you said, following your logic, Dale, and if you have Donald Trump winning the election and then on becoming president-elect, he states that he would like to have a lower dollar, immediately you will see the dollar take a dip with respect to other currencies. The second way that can be done is anything that is done in terms of trying to lower interest rates or pushing
Yes.
the Fed to lower interest rates, as Trump has done on past occasions when he has criticized the Fed in terms of the interest rate policy. If that happens again, I'm assuming he becomes president-elect and then president. If those happen, that is also going to cause the dollar to go down. So there are lots of ways of doing it. If you have the country's president who repeatedly says he or she wants a weaker dollar, then you will have a weaker dollar.
Okay, interesting. And I don't see anything bullish for the dollar on the other side either.
I don't see anything bullish for the dollar on the other side unless you have an economic revolutionary thinking. What would that be? They finally start worrying about the size of the fiscal deficit. They find a ways to reduce the deficit from the current levels where it is unsustainable. Any move along those lines will clearly strengthen the dollar. Second, on the monetary policy side, if you follow anything like one of my other professors on my PhD committee, John Taylor, currently at Stanford University, and you follow a Taylor rule, which essentially says, here are the rules you should follow for setting interest rates. If inflation is higher than your target, then increase interest rates. If growth is lower than your target, then reduce interest rates to stimulate the economy. Other than that, you don't have to do anything. You don't have to give press conferences and speeches. Actually, all the Federal Reserve members can stay home, and we will actually pay them a higher salary if they don't come to work. Because there are set rules that they have to follow in doing it. If you do that, then also the dollar is going to appreciate, because people will say this is a very disciplined central bank that we have here.
So the confidence crisis on the dollar is also the confidence crisis in the Fed.
Exactly. That's right. You said it very well.
Kamal Shri Kumar. Really great to talk to you again, Shri. Really appreciate your insights into what we're looking at ahead for the U.S., including people to be on the lookout for what's happening with the banking industry, because the recession could be sparked from that rather than a weak economy. The financial crisis first, and then the weak economy, and consumers pull in their horns. Is that your pattern?
Yeah, that is clearly one plausible scenario. You can go several different ways after the elections, but the elections are a crucial milestone in terms of date. And after that, there is clearly the risks increase.
When will we know who the president is? You don't expect it to be known on election day, do you?
Well, I hope we get to know. That used to be traditionally the way we would find out. You would know it by election day night. But I'm hoping that if it's not that night, within 48 hours, the person who wins will become clear.
Okay. Um, Thank you so much, Shri. Really appreciated you coming on to TradeGate Hub and edifying our community. Have a great fall. And I suggest people go to shrikumarglobal.com and check it out. Do you have any pieces that retail traders can read and have access to?
I put out my Saturday reports on Substack. It is called Sreekonomics. And you can either search on Google or you can, as you said, Dale, go to my website and you will be able to do it. I also put it out on Twitter every Saturday. There are so many different ways of accessing it. I think my technology is not up to par, but as best as I can tell you, the various people can put themselves on the subscriber list themselves, and there is no paywall.
Right, I've done that. And I propose this, and I hope you're ready to step up, that you become our next Fed chairman.
Thank you very much. I appreciate your confidence. But one thing I say is they do not want somebody who speaks his or her mind and who is inflexible with respect to principles. So the chances of that happening are close to nil. But I thank you for your suggestion, Dale.
Yeah. You're who we need, though, Shri. Shri for Fed chairman. I'm going to put it out on social media. There'll be millions of people that agree with me.
Thank you.
So great to be with you, Shri.
Thank you.
Thank you.
Wonderful to be with you. Great to do your show, Dale.
All right, my friend.
Bye
Shri,
bye.
take it easy.
You too. Bye bye.
Bye bye.